Hey, what's up, YouTube? Today I'm going to talk about Berkshire Hathaway's 2021 meeting and my own take on it. As you probably know, this meeting happened last week in LA and it featured both Warren Buffett and Charlie Munger. So, the first thing that caught my attention was at the start of the meeting, Buffett talked about the stock market in general. As you may know, Buffett very rarely talks about the stock market in general and usually focuses on individual stocks and businesses. I think the last time he talked about the market in general was back in 1999, when the internet boom / mania was in full force. This time he used the words casino and, quote, new entrants of the market, unquote, and he told them that investing is not as easy as it seems. To give an example, he listed a table of the world's largest companies by market cap in 1989, and he compared them to the same list in 2021. This is the list of the 20 largest companies by market cap in 1989. You can see that Japan was very dominant in 1989. As you may know, in 1989, the Nikkei 225, which is the Japanese stock market index, it peaked. And it took another 30 years to reach the same levels as 1989. And then he showed the list of the 20 largest companies by market cap in 2021. As you can see, none of the companies from the previous list made it to this list 30 years later. The key takeaway is that stock picking is not as easy as it looks, and dominance is pretty difficult to endure in the world of business. It seems like in the world of business, change is the only constant. Looking back, it was clear that the Japanese stock market was in a big bubble back in 1989. My take is that it's not clear to me that the US big blue chips are in a bubble right now. But I do believe that the returns of the next decade are going to be lower than the returns of the 2010s. Buffett also gave a list of the auto companies, which was a very hot sector in the 1900s. The list was so long that he had to choose only companies whose name started with MA, and even those companies filled an entire page. You can't even recognize most of these companies today because a lot of those companies went bankrupt. Only a handful of those auto companies survived and made returns for investors. Even though he did not use the words EV or SPACs when talking about auto stocks, but I believe he was talking about EVs and stocks of today. EVs and stocks are a very hot sector. The key takeaway is that even though a sector may be hot, the stocks in that sector may not make good returns for investors. Another interesting topic was inflation. Buffett says that he's seeing substantial inflation and that people are raising prices to us and it's being accepted. Buffett owns some 80 or so businesses outright, and he was talking about those businesses when he said these words. The key question in my mind is whether or not this inflation is temporary or enduring. One thing to keep in mind is if you look at the year-over-year metrics, they may seem very high, but that could be because the prices last year were quite depressed. If you remember, oil was trading in the negative territory last year around this time. Buffett also talked about extraordinary fiscal and monetary stimulus. He said, so far we have not had any unpleasant consequences from it. People who get the money feel better, it causes stocks to go up, it causes businesses to flourish, it causes an electorate to be happy, and we'll see if it causes something else. I believe he was talking about inflation. That something else is inflation. He did not say that openly, but I think he was talking about inflation. Moving on to big tech valuations, when asked about big tech, he said, we don't think they're crazy. He was referring to the valuations or the PE or the PS ratios of big tech. He was saying that with low interest rates, big tech valuations are justified. Just to be clear, I don't include Tesla in big tech. In my mind, big tech is all the cash gushing companies like Apple, Google, Facebook, Amazon, and so on. Moving on to the banking business, Buffett said that he likes banks, but if you look at his actions, he exited Wells Fargo last year and he trimmed JP Morgan, although he did add to his Bank of America position. So maybe it's the case that he dislikes specific banks, but he likes the sector in general. As far as repurchases are concerned, they bought Berkshire Hathaway B stock for $251 recently, so he and Charlie probably believe that the intrinsic value of Berkshire is higher than that. Finally, here are my key takeaways from the Berkshire Hathaway annual meeting Q&A. The number one takeaway is to stay away from speculative frenzy that is going on in hot sectors like EVs, SPACs, and cryptocurrencies. Secondly, we must carefully monitor the inflation situation and own stocks that can give good returns even in an inflationary environment. And lastly, macro is very difficult to predict, and that we must own enduring businesses, enduring stocks at reasonable prices, because capitalism is brutal for business owners.